So you're buying and selling shares all the time. Is that long-term investment or short-term investment? Both. Long. Okay? Majority long. Is there anybody who is sitting here today and hasn't got a clue of what they're going into? They're getting into. Okay. No, that's great. Because we're going to show you how. All right. And those of you that are already buying and selling shares, we're going to show you how to make your selection even better. So we're going to streamline it for you. Okay? Great. Now, we know what your aim is. You want to achieve a certain level of financial success. Right? You're sitting here today. You've got goals and aspirations, a house, a holiday, or whatever it is. Reduce debt, that kind of thing. Okay? Our aim at Share Direct is obviously to empower you to get that necessary knowledge so that you can achieve financial success. Okay? Now, we're going to have a look at the introduction to investments. So, basically, if you're working for a salary, okay, you're not going to become rich. You've obviously accepted that. Otherwise, you wouldn't be sitting here today. Okay? Because nobody gets rich working for a salary. So we need to find a way where we can invest money, okay, and get a return on our investment, but a decent return on our investment, so that we can achieve those financial goals. All right? So we want to put as little as possible in and get as much out. We're here to make money. Okay? If you had to take this scenario, we need to get out of that little fishbowl that we're in, okay, and start seeing the reality out there. This scenario is a pyramid where we take 100 South Africans that finished school last year. Okay? By the time they reach the age of 60, retirement age, 49% of those will be dependent on charity. Okay? They'll have to look after your mothers and your fathers because they won't have any money. 29% will be dead. Unfortunately, that's just the way of life. 12% will be broke. Okay? 5% will still be working. Okay, I don't want to be working when I'm 60. How about you? Only 4% will be financially independent and 1% will be rich. Now, I know that because you're sitting here today, you want to be in the top first and second of those quadrants, right? Okay, but the thing is, we're not really doing a good job of getting there, right? And for those of us who have financial advisors, I'm sure that they're not doing a good job either, or you think they're not doing a good job, because that's what I think, okay? So, there are 3 reasons why I think we won't get to the first and second quadrants, okay? One of those reasons is procrastination, okay? We always put off what we can do now because maybe we can do it tomorrow. Okay, what I'm referring to there is if you wait to start saving in 6 months' time, or maybe when I get a salary increase. No, I'm only going to start saving when I'm married. That type of thing. Okay, putting things off, what you can do right now, it's a decision, an active decision that you have to take. Okay, and not put it off. Right. The other reason is the lack of knowledge. Okay. Some of us are sitting here, we're already involved in the stock market and things are moving along quite nicely, but we are beings that need to keep evolving, okay? So that involves education. We need to educate ourselves and get the knowledge so that we know that whatever we're doing a proper job of it. Because it's our money we're talking about here. We are going to take control of our financial futures. And the third reason, specifically relative to the stock exchange, is that the perception out there is that the stock exchange is risky. Okay? It is risky. There's a chance that whatever money you put into the stock market, you're going to lose. Okay? So now we want to show you how to put the odds in your favor so that that doesn't happen. Okay? We're going to minimize your losses in the market. You are going to lose. The stock market is a funny thing. It has it's actually human nature. All right? Just 1 minute you think it's going to go up, it does a whammy on you and it goes down. Okay? And that's how it is. You need to accept that you are going to lose in the market. It's a game. And this game cannot be won. It can only be played. You need to play the game. So we're going to show you how to play the game. Any questions on that so far? All right, so what is financial independence? You don't need to explain the reason to me, but basically financial independence means that when the money that you are earning or you're working for, or the money from your investments, okay, is able to pay your expenses. And when your investment income can pay your expenses, that's financial independence, okay? Now, all of us have got expenses and bills to pay, home loans, cars to pay off, that type of thing. We've got debt, okay? We need to focus on getting that debt behind us. The expenses aren't going to go away. They're going to be recurring, okay? But we need to manage our money so that we can afford not to worry about our working income paying those expenses, but our investment income, okay? So the road to financial independence. This is where we are now. Blood suck, okay? No money in the bank. How are we going to get there? First, we have our financial plan. So we plan to trade, and we trade the plan. We stick to the plan. If you develop a strategy, which you're going to learn, a lot of factors are going to come into play so that you can develop your own strategy, and then you are going to stick to that strategy. Because if you can't trust yourself and your own strategy, then nobody else can. All right. We need to reduce debt. I think I've said that 3 times already, because that is the most inhibiting factor today. That is inhibiting people from getting involved in the markets. All right? Doesn't mean you have to have all your debt paid off completely before you start venturing into the market. You need to start saving a set percentage of your monthly income. So that means pay yourself first. I'm sure you've all heard about Robert T. Kiyosaki. Okay? Rich people are rich because they don't give their money away. Okay? If you're going to pay people, why are you not standing first in the queue? Pay yourself first. So when you get your salary, save first, the rest can stand in the queue. Pick a number. That's what I say. Right. And have investments in place that beat inflation. Now this inflation is two, you can look at it in 2 different facets. The one is your personal inflation. Now, everybody's got their own personal inflation rate. What I'm talking about there is your standard of living, okay? So your standard of living may be a little bit higher than mine. You may have children, I may not have children, okay? So my expenses are going to be less than yours. So your personal rate of inflation must be taken into consideration there, as well as global inflation. Now, global inflation is something that I'll go through in a little bit more detail. Now we're going to have a look at investment options. We know we've got a plan now. We're going to stick to this plan. Right. What's the next step? What is available out there so that I can start making the right investment decisions? Right. I'm taking an example here between the investing your money in the bank and investing your money on the stock exchange. Right? Direct comparison. Everybody knows that the bank is safe. Okay? You can put your money in the bank. It's quite safe. But if we had to take this comparison and a 10,000 Rand investment over a 5-year period. 10,000 Rand is a lot of money. Okay? Some people, it's their life savings. Where are they putting it? Are they putting it in the right place? Now, for example, if we take the bank over here at the bottom, you are looking at investing it 10,000 Rand over 5 years at 12%. Does anybody know what the interest rate is on the bank, in the banks at the moment? 5.7. Any other comments? Okay, is that good? Do you think that's good? Okay, it's not good. So why is your money still there? All right, investment options. Now, I'm just using this example. Let's take 12%. Let's give the banks a little bit of a break, okay? Okay? They give us 12%. The stock market, just a little bit of history there on the stock market. Last year we were in a recession. Do you agree with me? We were. Okay. Did you feel it? Did you feel the recession? Was money tight? Was money scarce in your pocket? There wasn't really money to spend. You didn't really feel the recession. Some people are very much affected by the recession and the lack of money, and others invest so they become recession proof. Okay. Now the stock exchange last year, the JSE All Share, gave us a growth of 30%. What did you say the bank interest rate was? 5.7%. 30%, 5.7%. There's something not right there, okay? So obviously, I'm going to take 30% as a reasonable growth. We do have other portfolios that have performed 65%, 85% last year. In a recession, we were in a recession. Yeah. Lot less, yeah. So I'm just going to use the example of a 30% growth, just to show you the difference between the investment options. After 5 years, we'd have 17,623 in our bank account. That's great, okay? We'd have no capital gain because we put in 10,000 Rand and we're only getting the interest. So that is our income. Our income in the bank is interest only. And we do pay tax on that interest, okay? Then, if you look at the stock exchange, there with your 30% growth, that 10,000 grew to 37,000. Now, that's a little bit more like it. And in addition, you'd get capital gain because as the share price goes up, you are earning, okay? You are making profit as the share price goes up. And you are receiving dividends. Now, dividends is a little incentive or a little thank you. We'll discuss it in a little bit more detail later. That you get from the company for being a shareholder, for investing in that company. The company pays the shareholders dividends. Now, these dividends get paid to you either in the form of cash or you can repurchase shares with that money that you get. But it's free. It's free money. And why I say it's free money is because the government also imposes tax on the companies if they're paying dividends to their shareholders. So the company's paying the tax on your behalf. You are then relinquished of the tax obligation. So your dividends are tax-free, 100% tax-free. Okay, I'd rather get the dividends, capital gain, than the interest and have to pay tax on that interest. Would you agree? Okay, so there's just one comparison. But not all of our money needs to go into the stock market, okay? I'm just making a comparison here. You need to have your eggs in all these little different baskets. You can't put all your eggs in one basket, okay? So I'm not saying take your R1 million tomorrow and put it in the stock market.